Hello everyone, welcome back to the channel, Matt with Green Bar Trading, and welcome back to another weekly watch list video where we go over everything that you're going to need to know for the week ahead. So just getting right into it, trying to make this as quick as possible, the earnings for the week. So as you guys can see, a lot of earnings this week. If you're interested in any of them, they're right up here. Getting to the economic calendar for the week. So looking at that, Monday, we have a couple of Fed after the bell, just about. Tuesday is election day. Get out and vote. Wednesday, a Fed at 3 a.m. A couple of other things. 11 a.m., the Fed president, Richmond Fed President Tom Barkin is speaking. So you have a lot of Fed governors talking. So you're going to see this week, you're going to see a lot of, statements coming out in the press, whatever it is. Algorithms will like to trade this type of stuff. Like we saw last week, huge week for the macros, huge week for the algorithms, a huge week for volatility. Last week, FOMC, Powell, the jobs numbers on Friday, just insane. So we need to know our economic calendar. On Thursday, CPI. All right? Thursday is the day you're going to want to mark on your calendar. It might be a day to, take the day off. Or if you're going to trade, you have to abide by rules. You have to manage your risk. These days have been extremely volatile. I'm going to show you what Friday looked like with the jobs number. It was just a very choppy day to trade. So from a technical point of view, it wasn't very good. So the best thing to do during weeks like that is just take the week off. Watch from the sidelines. Build some watch lists of stocks, of things you're interested in investing in. But to try to day trade it, it is very difficult. So Thursday, that's the big one. That's the CPI. So what we did see on Friday, these are the numbers of the payroll. So at 8:30 a.m., before the market opened, we got all our payroll numbers. So you can see here, one thing that the market liked was that the unemployment rate ticked up a little bit. So you can see here 3.7%. They were expecting it to tick up to 3.6. So that was a little bit worse than expected, but good, I guess you can say, as far as the Fed goes. So what we're seeing in the markets today is bad economic data, bad jobs numbers is good for the market because it's saying what the Fed has been doing all year is finally starting to work. They want to see the labor market loosen up a little bit. It's very, very tight right now. So, like I said, when you get these numbers, they can have a really big impact on the overall market. So just know your economic calendar. Very important. So that was what we saw on Friday. Looking at the sectors for the week right here, one day. This was Friday's trading day. On the week, this was the 1 week here. Technology got crushed because the Fed is going to have to raise rates. They're going to have to raise their terminal rate, which is that rate that you get to at their peak, right? So during a rate cycle, there is a terminal rate that the Fed wants to get to, which is the top that they get to, and keep it there for a little while before eventually lowering rates back down. Now, when he said on Wednesday that they have to raise rates higher than expected and keep them there longer, that terminal rate's going to be higher, probably in the middle of next year. That's terrible for tech stocks. That's terrible for any type of growth stocks. So we saw technology get crushed last week. On the month, energy still leading the way. Financials, has been holding up really well. So that's our sectors there. Now, going over to the bond yields, you guys can see, I mean, we go over this every single week, but it's something that I look at on a daily basis as well. The bond yields, when they go up, the stock market goes down. All right. It's been like that for the entire year. You can see back in January where the 2-year has come from. I mean, sub 1% to almost 5%. That type of move in a year is unbelievable. So, that's why you've seen technology and a lot of these stocks where you're like Amazon, Google, Meta, these stocks that actually make a ton of money are getting crushed. So this is the reason. These tight, this hawkish Fed, anytime monetary policy gets like this, it's just not good for, growth stocks. So that's the 2-year. If we want to look back here at the 10-year, the 10-year right now. So if we take a look at this let me just do this, easier to see. Let's zoom this in a little bit bigger. All right, so if we look at this, the curve inversion on the US 10-year, which is sitting at 4.16 right now, going to the 3-month, which is the shorter dated notes, is 4.11. All right, you had this curve, it inverted a few days ago. So when you see this inversion right now, it's not inverted. You have a 4.11. You're still okay with the 4.16. This inverted, which means that the 3-month was yielding more than the 10-year, and it happened all week long up until Friday. So keep a very close eye on the shorter dated 3-month and the longer dated note 10-year. When these invert, it almost always leads to a recession. So we saw that all the way up, like I said, until Friday, when the 3-month pulled on back and the 10-year gained some steam. So, that's something that you're going to want to really keep an eye on going forward to see if that inversion takes place again, and, just monitor it. All right. So, we're looking, I mean, if you look at this right now, the 6-month is yielding 4.57 and the 10-year is at 4.16. You do have an inverted yield curve, but the one that a lot of people look at is this 3-month yield. When this one inverts with the 10-year, that's a really big deal. And it did happen last week, like I said, all the way until Friday. So keep an eye on that. All right, so we're done with that. Going over to our compass, the SPY, the S&P 500. This is what we're looking at on the year. Zooming in to Friday's trading day. Look at that candlestick. I mean, that is just huge. I mean, we started the week, we were in great shape. We were over the 50 moving average. We were over the 20 EMA. And then just as Powell spoke, we broke through all those technical indicators, all those key moving averages. That's why I always say big macro events can destroy technical analysis. We saw that, but then we got a bit of a bounce. We sold off again on Friday, jobs, numbers. The whole day was just a wild swing. And then we ended up with this nice bullish hammer candlestick on Friday on pretty decent volume. You have a trend line right now that I drew out here from the lows, bounced here to the penny. So right now, this is something we're looking at going into next week, the 50-day moving average. That's right within a stone's throw again. It would be nice to be able to break through that again. It's not a good sign that we broke down under it, but we did close just above by pennies, just above that 20 EMA, which is just ever so important to hold over. So we saw this sell off, knee jerk reactions, they usually happen, and then the market sort of corrects itself a little bit, making the weekly chart look a little bit better. Not closing at the lows, but bouncing off the highs. And all we did was basically give back the week before's gains, right? So that's where we closed at. The 20 EMA on the weekly, that's been a problem. That's been a problem the last time. So we just have to keep that in mind. But that's the SPY, that's the technicals. I do want to show you the trading day on Friday because this thing was crazy. 8:30, the jobs numbers come out. Boom, you get a big wick down. Big up. Drops on down. Comes right back up. Hits a high here, just about at that 50 moving average. And then sells off. Makes a lower low, right? Lower low. And then rallies back up. Right into, right here. So you had some resistance. Saw some resistance. Sold back on off. Double bottomed right here. And look at this. If you zoom in, if you're trading during this time right here, look at this drop. These are 1 minute candles. You have a 3 minute drop here and get all the way back up in the next 3 minutes. Very choppy trading. So you have a double bottom here, right? And then we start to sell back on off. And then you have a triple bottom. And then the market barrels ahead. Barrels on ahead. Just a crazy, crazy day. And then finishes basically where we opened up for the day. So that's what causes that small body that you see in the candlestick going over to the daily chart. So you can see here that body right here on the candlestick is very small, but you had a very big range for the day. So that's just something if you guys didn't know. All right, so that's the SPY. Looking at the Qs have been weak. This has definitely been weaker than the other indexes, like we had said before, the reasons I explained. Right here, this is the candlestick we saw on Friday. So the market definitely has some demand down here. The lowest close on the year was 60.49 right here, which was the day before. So we closed back in October. Was that the lowest close? Let me see. Yeah, so the lowest close was back here in October. Just a couple of pennies less right here on Thursday. And then we saw some demand, and again, you get that candle. You get that dip buy, right? On pretty, heavier volume. So there were buyers down there that said, okay, I think we've sold off enough. We're back to these lows. And sometimes you'll see an initial bounce. Now, I'm not saying that's going to, be the start of an epic rally. It is just a bounce off of the lows. And, you can see we're under the 20. We're under the 50-day moving average on the daily chart. We're also under the 200 moving average on the weekly. So not great, all right? Tech is not looking so good right now. The chart for the year, you guys can see. This is clear as day. So we're just chopping around here at the bottom. It's a very tough place to be in the tech stocks right now. But eventually, these stocks are going to be buys. If you can just buy them, hold them, maybe add to positions if we sell off a little bit more. There are some really good deals out there. So just keep that in mind. So that's the Qs. Going over to the Dow Jones. This is something we showed last week. And basically, to the penny, saw the rejection. So last week, I had said we had 3 closes over the 200 moving average. Well, history doesn't always have to repeat itself. But isn't it funny how it often does? 3 closes right here, 1, 2, 3, over the 200 moving average, and then a sell-off. And then it tried to come back up, got rejected by the 200, and ended up closing over here. So, while it did pull on back, we have to wait. We got to make sure that this thing can hold over the 200 moving average longer than it did back here. Because then that would be a break of trend, and then maybe you could get up to this downtrend line. But there's really, how much more room is there long here? I don't see the risk reward really being there, even if you did get up to this trend line. Now, it could always break out, of course, but the technicals are telling me that we're going to be dropping further. So that's the Dow. Looking at the IWM. IWM holding up better than the rest, never broke the June lows, and is now closed over the 50. That's good. That stayed over the 50, the 20 EMA, and you have a bit of a trend line here. So you have a bounce here, you got a bounce here, and then you have a bounce here on Friday. All right, so this is still an uptrend, trying to get off of the mat, trying to get off the bottom here. And then you have this downtrend line, which dates back to this year here. All right, so those are all the major indexes that we're looking at. Now we have to look at, we cannot forget bond yields on the year. You guys can see, we went over this before. As the yields go up, the market goes on down. This is something I look at on a daily basis. These are the last 2 days of trading right here. You kind of have this, doji right here, candle of indecision on Friday. So we'll see what happens with the market. But you saw the rejection up here, came down, broke out, and now is chopping around a little bit. That's the bonds over here on the dollar index. You have a huge breakout, pulled on back, came back up, and now you have this kind of forming a wedge for the dollar. It's either going to break out or it's going to break down. If it breaks down, that's good for the stock market, that's good for equities. If it breaks on up and we see highs, not good. So this is something we do look at every day. And look at that daily candle. Huge daily candle, and that's why the stock market went up. On the day, we opened here and closed all the way down here on the dollar. The stock market really had a much, much better day on Friday. And that's really an inverse correlation with what you see here in the dollar. All right, now let's take a look at the VIX. The VIX has been making lower lows, very nice pattern. As the market has sort of stabilized a little bit, we broke out a little bit in the stock market, and the volatility index, that fear index, has pulled on back. How far will it pull on back? Will it come back down to 20? That would be great. That means that the equity market would be doing really, really well. So we just have to keep an eye on that. Every day we're keeping an eye on the VIX. If you are interested, I'll put up here, come join our Discord group. This is a group, we're in here every single day, providing, daily previews as far as key levels, everything you need to know about what's going on in the stock market. All right, so getting back to this, I want to just show you guys a couple of things. A couple of charts I'm looking at is the XLE. Why am I looking at the XLE? Well, we have a double top here, right? So 93.31, you hit a high of 93.10, let's call it, and then a pull on back. We were consolidating, got the breakout, profit taking into previous highs, and now we pulled on back. This setup, to me, if it doesn't just consolidate here and break out on this week, this has the possibility of selling back on off. All right, this is the XLE. Not saying that has to happen, because this is something that you don't want to bet on for the year. I'm sorry, bet against on the year. This has been in a very nice uptrend. It's been outperforming everything. But if we look at this, I'm just going to take this off. Let's take a look at this on a way bigger time frame. Now, this is going back all the way to 1999. This is a weekly chart right here. What I see on this chart, I'm just going to take these off. We don't need them. All right, we're going to look at this. We're going to do this. All right, and I'm going to draw out what I see here. I see, and it's not a perfect head and shoulders pattern, but there is a head right here. You have a shoulder here that just happens to correlate to the exact penny right here. All right, so this is a weekly chart. There's a lot of volatility involved. But you've come to that shoulder now, right here. Will we see the pullback? You have a double top on the year. A double top is tough to break. We can still break it. I'm not saying that we, have to sell on off, but just be aware that you have a massive head and shoulders pattern on the weekly chart for the XLE. And that bottom is way back down here. So, just keep that in mind. I know a lot of traders are most likely taking profits off into these, elevated levels. So that's just something interesting, something that I noticed right there. And as far as stocks go, I'm not going to really go over any particular stock that I'm looking at. Last week, we had some charts that we were interested in, but the FOMC, the jobs numbers, we had said, in that video, if you're going to trade, you have to know that the technical analysis can really get crushed during those macro events. So hit the thumbs up for the video. I'll see you guys back on the next one. Take care, guys.